Today is Monday, July 1st, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADM Investor Services, and Alan Bush, ADMIS Senior Financial Economist. Steve, what did the USDA report say on Friday, and what was the market reaction?
The report was one of the widest misses by analysts that we've seen in recent history. The USDA said there's going to be 90 million corn acres and 80 million bean acres, and the average guesses was like 86 corn and maybe 84 beans. So there's maybe 4 to 5 million acres out there that the market feels will not get planted to corn and maybe get planted to beans. The USDA came out and said that there were 17% of the corn crop not yet planted. 15.5 million acres that basically they counted as planted. And they're going to resurvey 14 states in July and August 11th. If they need to make some changes on the acres, they will. And we were at one point limit down in corn. The funds going into the report were along 188,000 contracts, and they're liquidating out of those positions. And they had a small short in the beans, and we ended up a little bit higher that day on the beans. But now the market has to deal with these 90 million corn acres, which is bearish.
I see we're lower again this morning. Is that more of the same type of reaction to last Friday's report?
I think it's adding to it because the next 2 weeks, if I'm a corn and bean plant, I got perfect weather. It's going to be mid-80s, maybe upper 80s across most of the Midwest, and every day at 3 o'clock there's going to be a rain for about an hour. So I think the weather forecast for the next 2 weeks is ideal for the crops. Number two is at the meeting between the U.S. and China trade talks, they did not agree to buy any U.S. ag goods as part of the opening up the new talks, and that's hurting the market today.
So despite some talk of cooperation, nothing specific for the grains, which is not enough to support the grains.
Right. I mean, it doesn't feel like the Chinese need to buy U.S. ag goods. Their crush margins have collapsed. They really don't need the beans. They're still dealing with the African swine fever and the drop in hog numbers and the drop in pork demand domestically. They could go without corn. They could go without ethanol. But you know, just right now, I think that they have more leverage than the U.S. going into the presidential election and maybe trying to hurt the farm vote for the president.
Now, let's talk a little bit about the financials. Why are stock index futures sharply higher today?
Well, they seem to be overreacting to the news. Steve mentioned there was no breakthrough, and yet new highs for the indices. In fact, going back to this last month, June, we saw the S&P with its best June in 64 years to the upside, and the Dow with its best advance in 81 years. So clearly something else is going on other than just what's going on with the trade situation. And I believe that other thing is the interest rate environment as central banks around the world move toward accommodation. So the fact that we're so strong in stock index futures on news that I would not really call that bullish with the trade situation suggests that there's probably higher prices in store.
What is the outlook for the U.S. dollar in light of the better tone to the U.S.-China trade situation?
Well, today the dollar index advanced, but I think this advance is likely to only be temporary as interest rate differential expectations in recent weeks have undermined the dollar, and I think will continue to undermine the U.S. dollar index. And it looks like the Fed is likely to be more accommodative than other central banks, and that, I believe, is a recipe for a drifting lower U.S. dollar index.
Alan, after substantial gains in the flight to quality vehicles since late April, prices are lower today. What is the outlook for the SafeHaven markets now?
Okay, well, all of the SafeHaven markets have come under some pressure today with the what I would call slightly better tone to the U.S.-China trade situation. So they're all under some pressure. But this is by no means any kind of breakthrough, no suggestion that there is any type of near-term agreement coming. So all of the weakness we're seeing in the flight to quality vehicles today should be used as a buying opportunity, and that would include the Swiss franc, the yen, the interest rate futures markets, and the gold. I think all of these should be bought here, and I would look for recovery today and higher prices longer term for all of these.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to talk to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.